Thill is the Managing Director of Benefits Compliance Consultants and specializes in employee benefit administration. Her specialty is compliance and consulting. Iris joined Benefits Compliance Consultants, Inc. after 17 years of service with Marsh & McClellan Companies and has extensive experience in employee benefits, compliance, and regulatory matters. Benefits Compliance Consultants specialize in ERISA compliance solutions, including Form 5500 preparation and plan document services. Iris and the entire team strive to provide their clients with efficient and affordable ERISA compliance solutions and unsurpassed personal attention. Please help me welcome Iris Thill.
All right, good morning, everybody. Thank you very much for the introduction. I appreciate that. I got a couple notes here. So, as you've already learned, I do a lot of the ERISA compliance for your employee health and welfare benefits. We are not insurance brokers. We actually get the opportunity to partner with employees direct, TPAs, brokers, that allows us to have no issues of conflict. So we can help anybody. You can just give us a call if you want just some additional insight on some of the information that you're hearing or get some further guidance on some of the new rules and regulations as they come out. Now, ERISA sounds like a terrifically boring subject, so I'm going to try to keep it lively for you. First thing I'm going to tell you is I'm going to help you remember my name. True story. A couple months ago, I went to go visit a client, and I went to the front desk, and I asked to see the individual I have come to see that day. And so they said, well, let me ask who's calling. And I said, well, yes, my name is Iris. I'm here. I think they're expecting me. A couple minutes goes by, and out comes the individual that I wish to speak with, and she's got her hat on and a bag, and she looks like a ghost. And she's like taken off, and she sees me in the lobby. She's like, Iris. I said, yeah. I said, but I told you to come to see you. She's like, oh. She says, they came back and told me the IRS is here. So if you ever hear someone calling and leaving a name and message for you, make sure you listen. Might be Iris. So today we're going to talk about a couple of things. Like I said, I'm going to try to keep you awake. There will not be a pop quiz at the end, but I will be around for questions throughout the day. We'll open it up a little bit afterwards. If somebody's got something that's really pressing, I have no problem. Just go ahead and let me know. Otherwise, I'll be available afterwards. So the reason we're here today is gratefully thank you to Connell Insurance. Lots of people went into this. Colleen, I appreciate the introductions. Tom, I've had a pleasure to getting to know you and work with you. Deborah, I appreciate you coordinating all of this for us. And of course, Dave, thanks for making sure that my microphone works and the technology is here today. Couldn't do without you. Connell Insurance, as you guys are all familiar with, is a great organization and provides you with the benefits that you need in your local area. It's very customized and important that you have a good group that you can go to for questions, concerns, services, products, so on and so forth. So we appreciate Connell bringing us here today. And we're partnering with Connell to be able to provide you guys with the additional insight and guidance as so many things change. As you know, the most difficult function is to accomplish is this compliance piece in-house. It's such a hard job to be in your positions right now as HR, administration, directors, managers, to be able to know and understand. God bless the DOL and the IRS and everybody else for making this so complicated and hiding the ball from us. They don't always give us a checklist. Here, you need to be sure you're doing this, you're doing this, you're doing this, you're doing this. They aren't doing that for you. So we're here to kind of help you navigate and figure things out, whether it's just a simple oversight or help you to get a better understanding of what your requirements are going to be. So there's a lot of information in these slides today. I'm not going to go through them verbatim. I hope that you can use it as a resource if you need to look back on something or have questions afterwards. So, like I said, I'm not going to go all the way through unless you guys really want me to read the actual ERISA, Employee Retirement Income Security Act. Who's snoring? So obviously it's there. There is a good intention behind it. It was created with the initial intentions of being able to protect your employees and the employers and doing some transparency for your retirement and pension type benefits. And someone had the great idea that says, well, this is already here. Let's go ahead and apply it to the health and welfare employee benefit side of things. So it kind of fits, but they're two different beasts. So ERISA is there for a good reason, but you know, they make it tough on you. So we're here to make it easy. Fun stuff. All right. So which employees are subject to ERISA? Almost all of you. Whether you have one employee or multiple employees, if you have benefits, if you offer benefits, you oftentimes have to be familiar with ERISA. There are certain exemptions, but very rarely does that actually apply. That's going to be something along the lines of government plans and churches. And if you have to say, geez, I'm kind of a church, I'm not sure, then that's something you definitely want to have figured out. There are certain documentations that you have to have in place in order to determine if you are exempt under those means. Just because you are a city organization doesn't necessarily you're a government entity that's exempt. So always make sure that you know the rules, even regardless of the size. So for example, we'll get into this in a little bit more detail later, but even if you have 12 employees, you still have certain obligations. You may be exempt from the Form 5500 returns reports for now, but you would still have wrap plan documents and other types of disclosure and transparency that you have to disclose to your employees, which again we'll get into. It also protects you as the employers. So we talked about who has to file. So let's talk a little bit about what has to be filed. A lot of people say, you know, the big one I always hear is cafeteria plans. Cafeteria plans are exempt. Well, yes, but it's more complicated than that. So you offer a cafeteria plan, but the benefits that you provide through that plan, such as your medical, your dental, your vision that are offered through the cafeteria plan, those benefits are still subject to ERISA. The 5500 doesn't necessarily need to apply or reflect anything from your cafeteria plan, but the benefits are still there. So if someone says, well, I don't have to file because the cafeteria plan is exempt, that's not necessarily true. All the rest of the benefits are pretty, you know, run-of-the-mill. You're familiar with them, your medical, your dental, your vision, your life, FSAs, prescription drugs, accidents, EAP, that's a sticky one right there. That's getting harder and harder as everybody starts to do this telemedicine thing. They wonder how it fits into the scope of ERISA, and there's lots of different rules that have to be applied to make those determinations. That's the kind of geeky stuff we do. We'll help you. We have some simple language that we can provide you with to help you better make those determinations. Another thing that kind of brings up is there's some complicated words or dirty words that people say the word plan. Plan doesn't necessarily mean we're talking about your medical plan, your dental plan, your vision plan, unless they're all treated as separate ERISA plans. When we say plan, we're talking about an ERISA plan, which means you have to have documentation and record keeping for each of the plans you maintain. And as employers, you can choose to have one plan and put everything into that one plan. And there's some good reasons for that, and we'll talk about that in a little bit later. If you don't have the compliance to have a wrapped plan, then you may have separate plans, and each plan has the filing obligations. So let's say you've got an employer with 150 employees, and you have medical, dental, vision, and life. And if you don't have the information necessary to wrap them together and file for a single 5500, you now have 4 separate 5500s. It's not uncommon for employers to have that, and there's nothing wrong with that, other than the fact that you have risk exposure because penalties would be assessed on a per plan basis, and you also have administration. You have to have a set of documents for each one of those plans, and you have to have separate 5500s for each of those plans, which means somebody has to do that work, which means it's more money. So in most cases, it makes sense to consolidate. So that's the one dirty word, plan. The second one is, and I cringe, voluntary. All right. Voluntary gets also very confusing because voluntary, by definition of ERISA, has certain safe harbor requirements. So voluntary, when we say voluntary, means your Aflac, your Colonial, your Transamerica. Those are the ones that offer the critical illness, hospitalization, HIV, cancer, different disabilities, and supplemental. So that is what we're talking about as we talk about voluntary. And you can see I put a little note there. When you're talking about voluntary life, as the carriers like to call it, that's more of an optional. We're still running it through a cafeteria plan. It may or may not be pre-tax, but it still is a filing obligation that needs to be addressed. So, again, so simple, but so complicated. We have little checklists that can help you go all the way through this. And we're always happy to educate you to whatever level you want. Some people are just like, make it go away, and we will. Others of you are like, well, I want to know why this, why is that, and where's the instructions on this? We will help you all the way through those types of questions and concerns. This is just a nice highlight or overview of the different types of disclosure requirements that you may or may not be familiar with. We talk about plan document. That's going to be something your carrier or vendor may hand to you and say, you know, thank you very much, here's your document. And they also sometimes will call it, here's your SPD. Again, the words kind of get dirty because just because they call it an SPD doesn't mean that it's a compliant SPD. Again, hiding the ball, it's so tough. The carriers, I sometimes feel, aren't held to the same standards that they hold you as employees or employers up to. You know, I really feel that there should be some more regulations there, but we all know how we feel about more regulation. So we've got plan documents, wrap documents, summary plan descriptions. All these words are just exhausting and just make you cringe. And we can help you navigate through them. So it talks a little bit about what each of them are. And again, we're going to break it down into some more exciting individual slides for you down the way. But just so you know, these are some of the stinkies and probably the most common where people fall short and have penalties or risk exposure. So this is we're talking about plan design. This is where an employer gets the opportunity to take a look at what they have and what they need and how it's operated. And this is where you can choose to have a single consolidated plan. A person can have separate plans and move into a consolidated plan on a specific time frame. So if you had a calendar plan year and your client has what we call 6 different plans, medical, dental, vision, life, disability, and they said, I want to get rid of it. I like this consolidated idea. It makes sense to us. We'll make sure that you have all of the areas clear for being able to do the consolidation, and we can help you make that happen. We can help you do some documentation that then wraps around all of the carrier-provided SPDs so that you now have a compliant document that has all of the necessary elements. And we can give you, if it has a 5,500 filing obligation, we can also make sure that you consolidate them in the appropriate term. You have to terminate some plans and come up with a new consolidated plan. And when I say these plans, again, these ERISA plans, they have numbers. If most everybody is familiar with your pension plan or your 401k, those are numbered series 001 through up to 499. Your health and welfare benefit ERISA plans begin in the series 501. So even if you don't have a 5,500 filing obligation, you should have documentation that outlines the number the plan is. 501, 502, 503, 504, it goes up to 999. Don't see that very often, but they exist. And if you have a plan and you terminate it, and you can never go back and use it again. So it's also very important how you structure it, so that if you have plans 501, 502, 503, you want to consolidate into plan 505, you need to terminate them and make sure they're never used again. Something happens down the road and you want to add a separate retiree medical plan, you need to use the next highest number in that series to ensure that you don't ever go back and start to use a plan that you had already terminated. Once it's terminated, it should be done. You should never see it again. And so, as we talked about the advantages of consolidation, we talked about the administration, the costs, the penalties, the risk exposure. So, For example, if you, and I keep using the 5,500 example, I know a lot of you may not think that that's applicable to you right now because you don't have 100 employees. I'm telling you it's coming. We'll get into that as well later. But the Department of Labor is got some new rules and regulations that they're discussing, which will eliminate that exemption. So 5,500s are a total snore, but they're definitely going to be raising their ugly little heads. So it is important. So if you file and tell everybody I have just a single consolidated plan, but you don't have the appropriate documentation in place, and God forbid the DOL comes knocking, and they look at you and they say, well, you've been filing a single consolidated 5,500, you've been telling everybody that you have the intentions, but you didn't do it right. They could go back and make you go back to the beginning and have to file each of them separately. And each of them separately means penalties assessed per each plan. And you got to pay somebody to go back and amend all these filings, taking them all the way back. That is a worst case scenario. I have, in my experience, have not seen the DOL come in there and be that super evil. But it exists and it is a possibility. This is a little bit of a highlight on some of the reasons why you wouldn't be able to consolidate. Collective bargaining benefits, it's typically referred to and used in the terms of unions. Separate accounting and trust issues. It's not like they don't trust you, trust issues. It's more of like financial vehicles such as a VIBA trust. If you have a trust, then it's subject to financial records, and you have to have an accountant's opinion, and you don't want to add all of your benefits into that bucket, because then now you have extra work on all those extra benefits. So, and you would certainly know if you're, where's Tom? You would oftentimes know when your employer is funded plan, because they have a VIBA trust, which is a financial vehicle that they're going to use to be able to put the premiums, and somebody gets to invest that money, then you have additional financial records. Those that are due, those are subject to extra rules, reporting, additional obligations, and of course additional penalties in the event you don't do them right. So trust issues typically you wouldn't have to worry about. I know that you know, I think the local area sometimes have these multiple employer plans. Maybe you heard of the word MIWA. Those also get very complicated. We can do the assistance with those. If you have a MIWA, that's the kind of plan that you certainly wouldn't want to consolidate. All right, plan documents. This is the fun stuff. Everybody still with me? All right, no sleepers? All right, so plan documents. These describe the plan's terms and conditions related to the operation and administration of the plan. The insurance company, master contract, certificate of coverage, or summary plan is a document. It sure is a document, but it doesn't necessarily constitute as a plan document in compliance. It may exist, you may also have a plan that, I mean, if you offer benefits, you have a plan, but you've just never documented it. So there's lots of different loopholes here that could get you in trouble. Again, carriers will oftentimes provide all kinds of information for you. They're going to give you, you know, the summary benefit of the contract. They're going to give you a plan document. They're going to give you summary plan description. And you get all this paperwork. You're like, geez, what do I do with all of it? It's great stuff, and it certainly contains the information that is wanted, but it doesn't necessarily cover everything that is required and needed. So, again, it's the terminology. ERISA plan documents. Now, this is actually the specific as it relates to the summary plan description. All right, two different documents. A wrap plan document is going to have all of your legalese. It's going to talk about the administrator. It's going to give it a plan number. It's going to talk about the benefits that are offered within the plan, and it's going to have all kinds of disclosures that are required by the Department of Labor, and it's a terrible read. You do not want to have to sit down with that thing, but it is required. And so typically what we tell people is this is going to be the piece of paper that you're going to love it and hold it and sign it and stick it in your folder, whether it be physically or electronically, into its happy little home, and you hope you never have to pick it up. There's only usually 2 reasons you have to pick up that document, and neither one of them are very exciting. One would be a DOL audit. We don't want that. And the other would be in case you have any litigations or questions over claims or who was covered, where you actually have to reference that document, and that document would be pulled into the courts to help them decide how the case needs to go. So don't want those things. But with that, we also provide a summary plan description. And a summary plan description, excuse me, getting a little ahead of myself here. But a summary plan description, just to give you the inside out, is going to be a document that's supposed to be in accordance with the Department of Labor, certain type of font, certain understandability for your clients, regardless of who they are. If you have a Spanish community, sometimes you even have to provide them in Spanish. Again, they cover the basics, and they also reply and give them some of the additional notices that are now required by the IRS and the DOL. But it's supposed to be much more legible. Still would not take it home on a Friday night with a glass of wine and enjoy it. But it is there, and it has to be distributed to your plan participants. And what it does, if we do a WRAP plan or WRAP SPD, it actually goes around all of the carrier-provided documents. Because again, think of it like the gymnastics. The carrier gives you a document, calls it an SPD, but it only has certain elements. You know, it may rule the floor. You know, the floor display, and it might do the great job at a balance beam, but when it comes to other elements, they're missing. So you might have a great performance, but because you failed to do one of the required elements, poof, now you got an issue, you got a hole in it. So an SPD is an important piece of document. Like I said, it wraps around the carrier-provided information. Sometimes the carriers get it right. But then you have a perfect document, but it covers just one benefit. So now you're stuck with having it be its own plan. By wrapping them together, you can supersede the requirements and ensure that you've got all of your elements covered. And so that's what the point to this slide is, that there are 2 separate documents. Both of them have a lot of the same material, but they have 2 different purposes, and they have 2 different intended recipients. The plan document is a written document, an instrument in which the administrators must operate the plan. Again, talks about the specifics of claims and disputes, and different administrative rights and requirements, who has the ability to amend a plan or change a plan. And again, this is talking about know the rules. We're talking about the missing elements. And again, you know, the IRS and the DOL come out, and they can give you maybe like 12 bullets of what is required. But those are vague, and they're constantly changing. So we have a beefed up version of all the elements that are required in those documents. And again, fabulous stuff, guys. You don't know what you're missing. Here's the breakdown for your WRAP plan document. Again, this is referencing a wrap around plan document. It is using the existing contracts and communication materials as described by the plans. Again, it's taking in all the information that's been provided to you by the carrier, by the plan administrator, and by all the different parties affiliated with whatever benefit type you're dealing with. We take that and we put it in a shell, as we talked about. We're going to wrap around it to ensure that it meets all of the required elements. And again, this is the piece that you're going to, put all your pride and joy into, and you're going to sign it and hopefully put it away. We don't want to have to reference that. And so the consolidation document, otherwise, one plan document is required for each. So again, think about all that wonderful reading material you have to stuff into your folders and have to hang on to. And God forbid you have to get all that stuff out. So one shell to cover it all. And the same concept applies for the summary plan description. Again, taking all the carrier-provided information, and we're just beefing it up to ensure that it meets all of those elements, because in the event of an audit, you'd be in a pickle. But more importantly, it protects the employers and the employees to make sure you aren't covering people that you didn't plan and intend to cover, and to make sure that you aren't offering benefits or limits that you didn't intend to set. So it is important that you do understand them and you do read them. I'm just telling you, it's not the best read. It's not the most fun thing to do. You wouldn't invite your girlfriend over and say, hey, let's go through my summary plan description. Of course, I get that, but I'm a geek, so. And there's more exciting information. Summary material modification. Okay, so let's say that you came and you got your documents and everything's nice and pretty and tied with a bow on it, but now you're like, shoot, we just picked up a new carrier. Or, as you know, Coventry was bought by Aetna, right? So now all your documentation changes. Because when you get a wrap plan document, assuming nothing changes, that sucker's good for 5 years. But how many of you go 5 years without changing a single benefit? This doesn't happen anymore. The carriers won't even allow it because there's so many acquisitions. So when you have changes, there's a couple of ways to do it. You can either have the documents updated, which is a perfectly good explanation and logic to it because you can just simply go through and update the materials. It also then gives you the ability to have any updated notices and regulations that have changed, because those are always changing. Or you can do a summary material modification. This is another wonderful one-page read if you do it right. But what they talk about, the problem with the summary material modification is nobody gives the definition of what a material modification is. And if it happens mid-year or if it happens at renewal, so, and it has to tie back and has to be written properly so that it ties back to the wrap plan document and the wrap summary plan description. So, if you have changes, you can do so by just doing a simple material modification, or you can have the documents updated. This is the cafeteria. It's got lots of names. Cafeteria plan, POP plan, section 125. Again, they're all a vehicle that is a separate vehicle that you use to be able to have the benefits of doing things pre-tax and offer the savings to your employees and employers. It too comes with more exciting reading material, and it does have to have its own separate document. So again, just because you have something that calls itself a cafeteria plan doesn't necessarily mean that it's compliant, and it doesn't necessarily mean that it's a wrap plan document, and it doesn't mean that it's an ERISA plan document. It means it's a flex document. What a funny name. It's got so many names. Anybody else ever have that issue? Never know what people are talking about. Lots of names for it. And oftentimes, the wrap plan documents, the one we're talking about, the ones that need production, the ones that we can help you with, they will reference oftentimes the cafeteria plan, but it is not a substitute for a cafeteria plan. I promise we're almost done with these icky acronyms and documents. Summary of benefits and coverage. Now this is probably one you're all very familiar with, because this is one that certainly gets done, and you see it. This is what we all use to be able to look at our benefit options. Right? So it actually has to have specific information. You'll notice it talks about 12-point font. That's actually a rule, and the same thing would apply to a summary plan description. It has to have so many pages and have to be so legible to multiple groups of people to make sure that everybody can understand what their options are. Now, these are typically something that obviously are produced by your carrier. Your broker may help you put them together. They may be private labeled, but this is something that is also required, and it has specific requirements. That was even news to a lot of people. They didn't know that they had to have specific requirements for these documents when you go into your open enroll. Here's the perils and pitfalls. Again, I'm going to sound like a broken record. You're going to have language conflicts. This is where your document says one thing from the carrier and your intentions were otherwise. The inadequate or incomplete documents, insurance contracts, policies, handbooks, all of this information, they should all say the same thing and make sure that they properly disclose how you want the plan to look and how it should be maintained. I'm just telling you, oftentimes it doesn't. And it's tough. It's a tough deal. I don't envy people in the position that have to actually have all of these things in place, but that's why we're here. And it kind of creates job security, I'm not going to lie. So, language conflicts. Maybe times where the terms of the SPD conflict with another document. Changing plan terms. I'm going to make sure that when you do changes, make sure they comply with statutory and regulatory plan requirements before adding new terms to SPD. Required content, again, that's kind of like the floor exercise was spectacular, your balance beam was great, but you know, you didn't do the uneven bars. So the whole thing is shot. You can't win the Olympics if you can't do them all. And so it'll put holes in it. And again, most of the time, it's very, very common that employers don't have all of these elements, or they don't have the documents, because they're like, well, no one told us. We didn't understand. How are you supposed to figure this stuff out? So it's not uncommon for carriers and for employers not to have these pieces. And I want to say it's okay, but you run the risk. And the risks could be expensive. You know, the Department of Labor and the IRS do not get copies of these documents. These are documents that you put in place to protect you, to protect your employees, and to be in compliance. And the reasons they get tore up is because, again, you get either a knock from the DOL, or you have issues with claims administration. Somebody's, you know, you have a claims that goes into dispute, which goes into litigation, and they start exploring and tearing through these documents. Otherwise, you know, you might have a disgruntled employee. I would be impressed if they knew the rules and regulations and found some pitfalls in some of the documentations that you maintain, but that could happen. And this slide talks to you specifically about the different things that we've already mentioned. In payment of unintended benefits, coverage of unintended persons, loss of tax benefits and taxable income to employees if you don't do it right, benefit lawsuits, loss of favorable view standards for claims, appeals, and penalties in the event of an audit. Now, penalties, I don't know if you guys have seen some of the news and regulations, is that a lot of the penalties have been raised. They've updated the penalties. And so I'd have to double check because some of that information just came out. I want to say that that per day fee actually increased. But more importantly, you don't want any of those other items in front of it. You know, penalty would be the last of your concerns. And here's my stuff. I love 5500s. It's a total geek out for me, and I apologize in advance. But this is my favorite area. So it's annual return report. This is required for your pension filings as well as your employee benefits. And right now, as it stands, is an employee benefit plan. You have to have 100 or more, and then it applies. But the IRS and the DOL are coming out regulations we think that are going to take place in 1/1/19, which means they're going to eliminate that exemption, which means you may have a 5500 filing obligation regardless. That would be for, again, if you have a calendar plan year that goes into effect 1/1/19, that means you may have your first Form 5500 filing requirement due July 31st, 2020, which sounds like a long ways away, but it goes fast. So the purpose of the filing is to ensure the plans operate and managed according to certain standards and protect the rights and benefits, blah, blah, blah. We understand that. But at the end of the day, the 5500s themselves for employee benefits, are you ready? Census information. Yay! The bad part is, if you don't do it, then you can have penalties, and the penalties can be substantial. So the pension and employee benefits use the same form. It's the same form 5500. Because remember we talked about earlier, ERISA said, oh, this is already here. Let's just make it stick to the employee benefits because it was already created for pension. So both types of plans have to use the same form. Different boxes, mind you. So let's just take something that's already confusing and scramble it up some more. So now, if you have a pension filing, you have to complete these fields. If you have welfare, then these fields apply to you. Different types of codes and character codes and different types of attachments. The benefit of 5500s is assuming you do them, and you do them right, and you do them timely, there's no penalty, but they also don't generate any refund. It's not like your income tax return where you're going to have penalties due or a refund depending on how it comes out. Census information. Oh, and of course there are certain exemptions. We talked about the 100 or less. You could be exempt. Again, if you're government plan, you may not have to file the 5500. Some payroll practices. I hate to get into that. Severance is kind of a tough one. Again, your voluntary employees, if you treat them all as separate plans, and you've got AFLAC over here, AFLAC, if you treat it as your own plan and it has over 100, but if it meets 4 safe harbor requirements, it too may be exempt. So they're all over the place. It's like a landmine. And then, of course, temporary disability. That's more of a state statutory temporary disability. We've got New Jersey and different states that have that type of thing. That also gets a little tricky. If you offer benefits for simply maintaining state statutory requirements and you don't exceed those requirements, then you may be exempt. If you give them a little extra on the side, then suddenly, poof, your exemption's gone. So lots of consideration and work here. The long and short of the 5,500s are your deadline. They're due 7 months after the end of the plan year. So again, I always use calendar because that's the easiest, and that's the most common. I think probably 65% of all employers operate on a calendar plan year. If it's not calendar plan year, we usually call it a fiscal year, which could be any other 12-month period. Calendar plan year is due July 31st. So guess what I'm doing on 4th of July? I'm working. I work all summer. You can get an extension. Extension with a simple form 5558, will give you an additional 2.5 months, so until October 15th. Guess what I'm doing on October 15th? Sorry, Mom, can't play with you on your birthday. There are other certain types of exemptions. Very rarely do they apply. You can use the income tax extension. It gives you an extra month and a half. Don't know why you bother with that. The other thing that's about the extensions, this just goes into explaining how and why things are so goofy. The Form 5558 is one piece of paper, and you mail it to the IRS. The Form 5500 has to be submitted electronically and goes to the DOL. I don't think they ever communicate. I don't know why they couldn't be able to make them all a little bit more uniform. But this just goes to show you how discombobulated it is and how it could be. Like I said, transmission, we send them all to the Department of Labor electronically. You have to have credentials to do so. Logging into a government website and having to get more passwords, more user IDs. We take care of all of that. We found that it just works best for everybody. If we complete your 5500, we give it to you, and we give you your favorite pen, and you just sign it and send it back. We take care of all the rest. We put it into electronic format. We submit it to the DOL using our credentials, which means if you have a problem or a question or a concern, we're going to be aware of it, and we always address them. If you ever get a letter or a notice from the IRS or the DOL, do not knee-jerk and react. Call someone like me or a benefits compliance consultant. We can very quickly navigate what they're after and put you in the right direction. And I'll also tell you, again, don't knee-jerk. There was 2010, I don't know what they did. They must have hired a bunch of monkeys. They sent out a ton of inquiries and notices on stuff that didn't even apply. We had hours and hours and hours and hours of work to help people respond to these letters that didn't even apply. I don't know what they did. Somebody in the back room must have hit the wrong buttons and kicked out a bunch of notices that were, not applicable. So, don't be surprised. Don't freak out. Just give someone a quick call. Retention, you have to keep them just like everything else for 6 years. Again, you can keep them electronically. I know everybody's going paperless, or you can keep it in paper form, whatever you need. We also retain those information for you. Plus, the 5500s are census information. There's nothing, no PI there. So that's posted on the website. You can go to the DOL website and pull up a 5500 from anybody. Pension and employee benefits. Kind of interesting. Late non-filers. Again, all day long, our phone rings because someone's like, I didn't know. We tell them, it's okay. There's lots of us out there who didn't know you had a filing obligation. So we help people determine what their plan design is, help them figure out how far back they have to file, and we help minimize any penalties. The Department of Labor is so well aware of the lack of 5,500 filings, they created an amnesty program. This one's fun. Department of Labor's Delinquent Filer Income, oops, I did it wrong. DFVC, Delinquent Filer Voluntary Compliance Program. Those, again, I get very excited. Those are fun. Those are the great puzzle pieces. So we'll get into the DFVC a little bit later, but again, the penalties could be extremely significant and brutal. Now, most cases, in the event of an audit, if the DOL catches you that you haven't been filing, they usually give you an opportunity to go underneath the DFVC program, but not always. So, big risk exposure there, big one. This is the DFVC, non-filers. So this is the worst case scenario. This is if they come knocking on your door because they found you before you realized you had a problem. And the way that they can do that is they're using your 401ks and cross-checking them. If your 401k has 100+ employees participating, chances are you have 100 or more employees enrolled in health and welfare benefits. So that's kind of what we use as a tool, and so we know that the DOL is using that as a tool. Now, there was a couple years ago, they talked about how they upped the number of agents, and specifically, I think they had in Texas, that they were using that tool to cross-reference and check so they can catch for non-filers because they wanted the money. They needed the money for the penalties. So with that being said, we never saw a significant jump. They threatened it, but they never got around to it. Turns out they have bigger fish to fry. Who knew? So if you don't file, these are the updated penalties. Employers subject to $2,000, $2,063 a day, up to $1,100 for each plan, which is late, incomplete, or not prepared at all. Again, I will have to tell you, in my experience, I've never seen them come after them and be so egregious. Typically, they'll give you an opportunity to make it right. Willful violation could result in criminal penalties and $100,000 or imprisonment. Can you imagine going to DOL jail? I'm out. Of course, I would have fun. I'd poke at him all day long. The DOL 5,500 penalty deadline applies to each benefit. Again, remember, if we didn't wrap them, and we have separate plans for medical, dental, vision, these penalties can be assessed per plan. That's that risk exposure we were talking about. So not fun. This is the Delinquent Filer Voluntary Compliance Program, or DFVCP. Pretty cool, because they let you off the hook. In most cases, we're able to do a strategy for most people that we can kind of figure out how many years they have, and we can usually do some sort of a evaluation of their intentions. And sometimes we can get them down to just a single filing for multiple years, which means we can cap their penalties at $4,000. So the penalties per day could be $10 per day per delinquent filings. Obviously, that expires through the year, and so if you're over that $10 a day mark up to $2,000, it's capped at $2,000 per year. So we're going to go through a couple scenarios. You've got a $5,500 for a consolidated plan, and you are a month late. You've got $300 in penalties. You've got a single consolidated $5,500, and you're late for a whole year. Now your penalty is about $2,000. But let's say single consolidated plan, haven't filed since 1988. We can still cap you out at $4,000 penalty underneath this program. So it can save a lot of money if you go underneath this program. And like I said, we work with people to make sure that we can further minimize, ensure their risk exposure, and get their penalties down to a minimum. It's funny, that's how I capped it. So if it's 1 year, it's $2,000. If it's 2 years, it's $4,000. 5, 6, 7, still $4,000. So the Department of Labor says you need to go back and file for every single year, and ERISA was enacted in 1976. The Delinquent Filer Voluntary Compliance Program was enacted in 1988. So typically, if we have to go back to the beginning of time, so to speak, we go back to 1988. And yes, we've helped many people go back to 1988 and file. Obviously, there's missing information, but we have all the tricks and tools that we need to be able to get them filing, even though there's nothing exists as far as retention anymore. Downside, mandatory penalty. You have to go up and say, I'm sorry, please let me go. But they will certainly minimize that. And time may be of the essence. If you know you're late, like I said, the DOL could discover that, but we've typically found that we're able to get things pulled together pretty quickly. So for example, it takes us, depending if we have all the information we need for the most recent 6 years, even if we have to go back to 1988, I'd say we could probably get a client, scope their work, get approval, and have completion with as little as 6 weeks. So we can usually pull things together pretty quickly for people. If the DOL should send you a notice, you may no longer be able to participate in that. Again, I have seen them go back on that and say, well, why don't you go ahead, I'll give you 30 days to get yourself fixed. So just be aware. Audits. Government agencies to continue to develop new ways to regulate employee benefit. Isn't that the truth? They're becoming more complex, audits increasing in frequency. You may have heard some other vendors who do this type of work almost using like a scare tactic, like the DOL is coming, DOL is coming. They are, but they also have a lot bigger fish to fry, especially now. So they certainly are looking for audits in all due respect, but it's not like Armageddon. It's, you know, you may get selected and you may not, but there's help for you. And so we can go through, you know, we can even show you what a DOL audit checklist looks like. And then as it comes to audits, there's going to be stuff that's even out of my specific area of expertise, out of Colleen's, out of other groups on our team. But we have something called ERISA Alliance. This is a format that we have created that allows us to partner with other experts. So we've got 401k experts, we've got MIWA experts, we've got all kinds of different groups and access to people. So if I don't know the answer and our group doesn't have the answer, we have partnerships across the country who do have the answers for you. All right, past, present, and future, right? This just got shot up out the window, didn't it? We had here we go. There you go. That just got changed significantly, didn't it, guys? The unstable exchanges, the marketplaces, carriers pulling out, carriers going broke, acquisitions. We're talking about some of the things that have happened, Cadillac, tax, non-discrimination rules, more enforcement, 1094, 1095 penalty demands, and of course their appeal process. And I'm going to kind of connect the dots for you. As it relates to the 5500, we're going to go into some of that I've been talking about. They're going to make you file a 5500 even if you're less than 100. Can you guess why? Anyone? Because of your fantastic 1094 and 1095s. The government is going to start tying these things back. So for example, if you're an employer, you have to give your employees the 1094, 1095, and you have to complete one and send it off to the Department of Labor. The government can now use your personal income tax return and tie it back to the information that the plan sponsor gave them. That's why some of these appeals and letters haven't started to go out yet, because the deadline was October 15th for a personal extension. And so the 5500 is going to do the same thing, and they're going to make it full circle on the other side. So by making the employers file a 5500, even if you're less than 100, now they can take the other forms and tie it back to the 5500s from the employer. So they have a way to track and manage that information from the employee end. The 5500 will complete that circle on the employer side. They'll be able to match those forms up. At least that's the theory. Now, I don't know how all that's going to look. We don't know exactly what's going to happen here. I think we're sitting in front of a pretty smart group, and I think you all have your ear to the ground, and you've all seen the news, and you've read the articles, and all the wonderful posts and blogs about kind of what's going on here. It's a question of a repeal or a dismantle. I think we're probably looking at a repeal, and I think that 5500 piece will still stick around. It still provides, the 5500 was completely outdated and didn't provide sufficient information for reporting on the self-funded benefits. So with these new expansions, they're going to bring it full circle. So I think that 5500 piece is still coming, but you'll have to stay tuned. We follow very closely and try to put out some short, sweet, legible articles, but we don't inundate people. So if you want, you can check out our website and do some of those fantastic social networking pieces, whatever your jag is, whether it's Twitter, Facebook, LinkedIn, we're out there, and do just a few posts, don't inundate you, so you can kind of keep up on what the latest and greatest is. These topics, I think you've all heard. You've talked about the Obamacare. We're not sure where that's going to go. I think it's more of going to be, the repeal, allowing sale of insurance across state lines. You guys probably know much more about all that. Households to deduct for HSAs, expanding HSAs. You know, I think in the end, as it relates to the compliance, I think we're still going to be living in a nightmare state, at least for a while, till they get everything sorted out. And they're still going to have, because there are good reasons behind it. You know, the disclosure and the transparency is always a good thing. So I don't think your 5500s are going to be going away. And your documents will still have to be maintained, might have some additional components you need to include. All right, this is way too small for anybody to read, and that was kind of intentional. This is just an example of the type of checklist we try to make for people to simplify it. We just want to take it down to the basics. You know, ask some simple questions. You know, if you know the answer or don't know the answer, it will certainly help us kind of figure out where you're at and where we might need to put you as far as consulting and guidance. And you can get something like this. You know, Connell does a nice job of maybe at open enrollment or renewal, sit down with a little document like that with your employers, employees, your employers, excuse me, and kind of go through some of those things. Regardless of what you do, you certainly want to make sure you ask these questions. As you guys go through the renewal and open enrollment process, you're going to want to make sure you ask these questions. So these, you know, are you getting the help that you need? Do you need to get some additional assistance, guidance, oversight? You know, we can do a quick compliance audit. It's a good review exercise as you're going through all of that fun stuff at open enrollment and renewal anyway. These are the reporting changes. On your slide, you're going to see what it's all about. It's all about the money, the penalties, the imposing fees and assessment of penalties. But this is what they're talking about. They're going to modernize the financial reporting. I'll pull that back off so we can read it. Improve the transparency for statutory oversight. That makes sense. Provide greater information regarding group health plans. As I kind of alluded to earlier, your current 5500s have an attachment that is required for each fully insured benefit contract, but there's no schedule attachment for anything that's self-funded. People used to use the Schedule C to disclose your fees and commissions that may have been paid for the administration of a self-funded benefit, but in 2009, when they revised that form, they kind of provided some clarification that suggests that we're exempt from it. So nowhere on your 5500 are you giving anybody any information about your self-funded benefits. Again, disclosure, you're kind of missing the mark, and I'll tell it's also very interesting and very helpful for people like me or people like your agents and your Connell insurance, because you can pick that up and very quickly get a very good understanding of who your client is and where you might be able to help them. You know, what brokers are they currently using, what are they paying for commissions, premiums, that kind of stuff. So it's helpful information to have it disclosed. And that's the service provider fee information. That's our Schedule C. Enhanced compliance with ERISA and the code. Again, that's where I think they're going to bring it full circle and be able to kind of conduct those audits. All right, everybody, we're getting close to the end. Okay. So schedule time with your local agent. Know your regulatory compliance requirements. There's a ton of them out there. I mean, there's all kinds of people who are putting out different types of checklists. Doesn't mean they're right, doesn't mean they're wrong, but there's all kinds of material available for you, even if you just want to kind of get your toes wet. Ask questions. Don't ever be afraid to ask the questions. Complete the quick compliance checklist. Contact us or any agent with any of your questions or concerns. For more information, here is our contact information. We are available, our organization, we have a headquarters in Des Moines, Iowa. I work out of St. Petersburg, Florida. We have clients from almost every single state. So we have people answering the phones from Eastern Standard Time to Pacific Standard Time. So you can always get an answer. If we don't have the answer for you right off the hook, we can typically get you something within 24 hours. And we're always available. We're not afraid to let you know that maybe this isn't our area of expertise, but we'll never turn you away. We'll just let you know that this is maybe the person you need to partner with for your particular types of needs.
Are you at a point where we can look at doing some Q&A?
Absolutely. Yep. I just have the last slide there talks about the different types of things that we have expertise in and can help you out with. So absolutely, by all means, let me have it.
So I just want to thank Iris again for coming up from Florida to be a part of this. And as she mentioned, we have worked with her on several accounts and look forward to many more and helping employers with compliance. As you just got to experience, ERISA plan documents, 5500s, is a very monotonous topic, very important topic, and one that has a lot of different elements that need to be looked at carefully. And in our benefits consulting role, we want to be able to talk about that. However, there's a lot of detailed questions that require us to have an expert in this type of field, which is why we go back to Iris or Andy Haynes, for those of you who know Andy as well. So with questions, I have one that I already know exists, would ask, you know, with small employers or with employers in general, you know, sometimes we add the medical for a calendar year effective date, and then we come back and we'll have some ancillary programs with different effective dates throughout the year. So in that situation, would you care to kind of elaborate what that may look like from a wrap document, how that works, and what we need to do from a compliance standpoint of getting that all ironed out?
Absolutely, that's a great question. I didn't touch on that. So in your ERISA plan document, you will have to make reference to your ERISA plan year. That typically is the date of which you have a general open enrollment, but there's not to be said that you don't have different effective dates for your different benefit contracts. So for example, we've got a client that's a consolidated 501 on a calendar plan year, but the dental renews 3/1, vision is 4/1, life and disability is 7/1. The documentation will dictate what their plan year is, and if they have a subsequent 5500, that's the figure that's going to determine when your 5500 is due. Now it gets a little bit more complicated because if you have a 5500, you then have to report the Schedule A for the period that would have ended within the plan year. And this is the part that gets really confusing. I didn't even add that slide, but that's where you can guarantee that our expertise will help navigate that for you. We'll tell you exactly what we need to look for. We'll make those questions and ask for the renewal dates for all those different benefit types so that we can accurately give you a checklist of the schedule information that we require.
Thank you. I was told that I have to hold the mic closer for recording purposes. Specifically with 5500s, I think it may help you to kind of get a gauge of the audience and what that may look like. So if you are an employer with under full-time or 50 full-time employees, would you raise your hand? Okay. If you're an employer with 51 to 99 employees, full-time employees, if you're an employer with 100 plus full-time employees, if you're an employer with a self-funded, partially self-funded with stop-loss, self-funded employer, regardless of employee count, would you raise your hand? So we have a handful of self-insureds as well. And if you are an employer that's a part of an association health plan, would you raise your hand? So we have several of those in the room as well. And one thing that I would want to make clear is that the requirements for each one of those segments, and I think Iris would agree, is it all tweaks a little bit based on your size and the filing and what that looks like. So no one situation is ever going to be the same as it relates to your compliance. There are standards and staples that I believe Iris kind of talked about. Again, the plan documents, the documentation, the material modification notices. But each one of you may have a very unique situation that is specific to your organization, your benefit offering, and so on. With that, I'd like to ask for someone to be brave, and the first person to ask a question for Iris, I have a gift card. I'm not going to say who it's to or how much it's for, but I'm looking for lots of questions so that we can try and get some answers and help you as clients, as employers with your compliance journey.
I like that you have to bribe them.
Okay, perfect. Missy?
At what point, and I'm specifically talking about 401k, do they require you to have an audit? And I think I know the answer to that, but I'm trying to remember.
That is a great question. Again, so many different components go into that. Depends on the employer type, the size of the employer, and how the plan is funded. 401k area is not my area of expertise, but there are certain thresholds. So, for example, if you are a defined contribution plan and you exceed such dollar amount, then there's a threshold there for that. But again, many different components go into that. Depends on the type of the employer you have and the number of your employees and who's contributing and how those contributions are made. If you have some specifics that you just want to get some confidential, complimentary information, you've got my card there. Please email the info@BC2, and we can get you that answered based on some of the specifics. Oftentimes, if it's EINs, EIN is employer identification number. That's how the DOL tracks your filings. Remember, so if the IRS or DOL does an inquiry, they're going to use your EIN number and then the plan number that they're searching for. Same thing applies. We go to the DOL website, we put in your EIN number, we can immediately pull up and kind of get a better idea of who you are, where you're at, how many employees you have, and what your needs might be. But an EIN number, people like to think of it like a social security number, and they tend to not want to give it out. But it is public record. So if you want to email me something, the EIN number will immediately give me 150% more information than a plan name or an employer name.
So just to piggyback on that a little bit, so the IRS, the Department of Labor, has released their fiduciary rule. So as an employer, you need to be, and I'm not the expert on it, but you need to be ensuring that as a plan sponsor of a 401k or a pension, that you are actively looking at that program, looking at that plan, and ensuring that you're a good steward of your employees' funds or assets that they are contributing to the plan. So that is something that is a very hot topic right now with the IRS and looking at employers and making sure that they are being good stewards. And it's kind of commonplace, and I think Travis, our next speaker, may be able to jump in on that conversation over the second half of the morning. But I think that may be a good follow-up.
Are there any governmental agencies that are not exempt from ERISA?
Any government agencies? Again, it gets tricky as you get into different municipalities. They would have to have specific documentation in place and have to pass certain tests to be able to designate themselves as a government entity. And so you'd have to go through, and we have a different simplified checklist where you can kind of go through and go, well, this applies, this doesn't apply, and kind of give you a better idea.
So I see a lot of eyes churning and thinking and really probably reviewing your own personal situation. Again, one thing that I would just go back and mention is that the DOL and the IRS have announced that they have their proposed regulation out for a 2019 start date, and she touched on the ACA, the reporting, the 1095, 1094, 1095 aspect of it. But the other thing that is going to be a part of that is now the Employee Benefit Securities Administration is going to have your form, your filing. They are now going to know who you are as a small group employer that offers benefits, and the compliance aspect of that becomes extremely more important, because when they're looking at doing audits and looking at identifying who they want to go after, their pool is going to get so much bigger, and more employers could be subject to having an audit, and not to scare you, but to reiterate how important it is to have some of this basic compliance in place. Any other questions?
We made it all that crystal clear, huh?
If you're in a scenario where you have less than 100 employees and you do an acquisition and all of a sudden now you're over 100 employees, but then you may diversify something else and then you're back under 100. When you go back over, what is the time frame for which you have to file to show that you're now over 100 employees?
That is a great question. Mergers and acquisitions are a big thing. Go ahead.
Right, because there's no clarification. The IRS guys right now are just saying that you have to speak to a specialist, but we don't have any specialists. So how do you do that if you're, what's the time frame?
Well, I'll tell you the trick for it as it relates to ERISA compliance, disclosure, reporting, 5500 specifically. The rule is you have to count the number of people you have on the first day of the plan year. So again, calendar plan year position, you acquired somebody July 1st, which puts you at the 200 threshold, and then you kind of did some house cleaning and some reorganizations, and you dropped it back down to 99 by January 1st of the following year, you would still be exempt. The 5500 is based on the number of employees as of the first day of the plan year. But the acquisitions is another piece. You need to kind of figure out if it's a stock deal or an asset deal, and depending on whose liability it is, and if somebody else had prior filing obligations. So you want to make sure that you align that as well. That's something we can help you with. Can help figure out where that liability lies, who has the obligations. Do you need to terminate a plan and create a new one for this new group? All kind of bases around the EIN and the type of acquisitions. But those are very complicated, very common events, more so now than ever. Seems like everybody's kind of acquiring, merging. Great question. Thank you.
Well, IRS, I would like to thank you for joining us this morning. Again, it's a very complex topic. There's a lot of moving pieces. It continues to change and evolve. We appreciate your knowledge and expertise. And before we break for our intermission, I'd like to give you a round of applause and thank you for being with us this morning.
Well, thank you. I appreciate it. Everybody, thank your time. And there was a lot to absorb there, so don't hesitate to email us, give us questions. Let me know what you got. Like I said, we'll never turn you down. We'll either get you an answer or find you an answer. And I appreciate everybody. Thank you, Connell Insurance, everybody. Appreciate it.
Thank you.